Hello everyone, my name is Naveed Mohammed. Today I'm going to discuss a residency assignment on corporate finance. First slide. When evaluating American healthcare MRI facility purchase decision, I would employ a comprehensive approach balancing a competitive matrix with strategically considerations. My analysis would calculate the net presentation value, which is called NPV, of both purchase and lease options to determine create more value when discount at 9% required rate. I would calculate the enter rate of return, which is called IRR, to assess the profitability relative of company hurdle rate and to determine the payable period to understand how quickly initial investment would be recovered. Beyond this final metrics, I would consider the strategic implementation of ownership versus leasing, including control over the asset, maintenance, responsibilities, technology obligations, risk, and a potential capacity of considering of lease. Tax implementation, tax implementation would be a critical particular examining how the new tax implementation on investment profits affects the depreciation benefits. Finally, I would assess how each option will implement the company's balance sheet, financial flexibilities, and the capital structure. The net present value, which is NPV, is the most important for American healthcare MRI investment decision because it is comprehensive account for the valuable time, money, qualifying the actual value created by investment in today's dollar. Unlikely similar metrics such as payable period NVP incorporate all cash flows, equipment, entire useful life, company's cost capital, which is 9%, and the initial investment amount. A positive NVP increase the shareholder value, while the negative NVP shows a destroying value. In this scenario, NVP is a particular critical because it allows a direct comparison between purchase and lease option. By converting both the alternatives or a common basic present value. Additionally, MVP inheritance accounts for tax exemption benefits, what are the adjusted to reflect different authorization scenarios, making it the most holistic and a financial sound for a capital investment decision. To properly evaluate American healthcare MRI investment decision, I need a several critical pieces of information classified. First thing first, I need to understand a specific tax implementation by government exemption. What percentage exempt? Does it apply dispersion benefits and how far long it's gonna last? Second, what are going on operation cost associated with both purchase and leasing option, including maintenance, staffing, insurance, and a potential upgrade expenses. Third one, what revenue stream will be MRI facility generate beyond the stated cash flow and consider the organization as utilize forecast. And the fourth one, what financing options are available for 3 million purchases, including interest rate and a long length. Fifth one, How does the investment align with the healthcare American long-term strategy plan beyond the final five period? The final one, what happens after the final or initial 5 year term ends? And are there any end of leases obligations or removal of options to consider? These details would be a significant enhancement the accuracy of my capital investment to analyze. Net percent value NVP and internal rate return IRR are the most appropriate measurements for evaluating healthcare Americans MRI investment because these incorporate the time value which estimates 10-year assets. NVP directly qualifies the investment contributing company value today's dollar, making it the ideal for comparing a purchase against the lease option. IRR complements is by revealing the project percentage return which can be compared by 9% hurdle rate. While payback period provides a valuable liquidity instance of a capital investment, healthcare organization it fails to account for cash flow beyond the payback point. Additionally, a present value analysis leases the alternative provides direct compatibility together. These measures create a comprehensive framework that balances the financial return with particular consideration supporting the response supporting the responsibility recommendation analyzed with the healthcare American strategy for final objective. Purchase option result NVP basic cases as 100,384.5, NVP conservative which is 4,302 and 71.35 cents, which reduces the cash flow after 5 years. NVP optimistic which is 700,408, which increase the cash flow after 5 years. IRR basic case that's 10.45%, payback period is 7.50 years. Leasing options NVP lease cost is 3,889,651.41. NVP operating cash is 1,05,507,901, where NVP leasing options are 2,331,335.67. Key assumptions made. After initial 5 years, the MRI will be continue to generate cash flow, will remain for 10 after useful life. Second one, tax exemption, which reflects in cash flow figure provided. Third one, the 400,000 annual cash flow is the net of all operating and maintenance cost. Fourth one, no additional capital expenditure will be required during 10 years period. The fifth one, the company has sufficient capital for initial investment. Sixth one, for leasing 400,000 annual operating cash flow still applied. Sensitive align analysis. The NVP remains positive when discount rate increases 10%, but it turns negative at 11%, including the investment has moderate sensitivity of capital cost changes. Based on the financial analysis, purchasing the MRI facility is very clear supervised to leasing. The purchase operate is a positive NVP, which is $1,038,168, and IRR is 10.45%, which exceeds the company's 9% hurdle rate. Even though payback period is 7.5 years, beyond 5 years analysis period, investment creates a long-term value. The lease options has a sustainability negative MVP, making it the financial unattractive. Financial Care American should proceed with purchasing the MRI facility rather than leasing it, assuming have a capital available and authorized forecasts are reliable. Two significant risks are associated with the investment of MRI facility, including the financial risk and the regulatory compliance risk. Financial risks are arises at the potential change in interest rates or unfavorable financial terms that would increase the cost of capital, ultimately affecting the overall profit of the investment. In a interest rate rises, the cost of borrowing of exceed the initial project, reducing the cash flow at the MVP. Non-comprehensive could lead to a fines or operational disturbs. Further, straight financial resources except the returns on investment. Both the risk required proactive management and ensures that investment remains at valuable dynamic, regulatory, and the financial landscape. The references are Fernando J. 2024, Inter-Rate of Returns IRR, Formula and Examples, and the other one is Fernando J, which is Net Present Value NVP, what means a step to calculate its interpotential. And the third one is Kang J, Payback Period, Definition, Formula, and Calculation. Thank you guys. This is my presentation. Have a good day.